Let's do something different today. Let's talk about how to survive the chip wreck. Today on the weekly update. Okay, friends, let's talk about how to survive the chip wreck. Here's what you need to know. First up, based on the panicked emails and calls I am receiving, we're going to talk about how to survive the chip wreck. Now, this is fairly unusual for me. I can't think of any time where the market was a mere 3% off of its highs, and I'm receiving so much inbound about anxiety and drawdowns and we're getting killed and when are things gonna, change. So I wanted to speak to that. In general, we're going to talk about the market. If you're in our models, in the stuff that we put together, you don't have overexposure to the chip space anyway. So this drawdown that we are seeing is really benign, really doesn't even register on the Richter scale. So what I'm going to be speaking to today is what people have been doing outside of our stuff, which is mostly loading up on risk in the chip space, treating the market as a casino, and, now the house is winning. So, but we're going to talk about how to survive the chip wreck, and I might give you some tools to help manage these anxieties. So first up, let's just go with the S&P 500. This is the same way we've always been looking at it. Yellow is the 50-day moving average. Purple is the 200-day moving average. And what do you notice? Well, we are deep in consolidation sort of territory here. It looks as though we want to release on our 50-day. 200-day has been firming up. We're somewhere around 700 on the 200-day. We're 729 is where we closed yesterday on the S&P 500. So there's not a lot of air for us to fall through before we're going to hit that trampoline that's the 200-day moving average. I don't even know if we're going to need to get there. We've put in bottoms around 721, a little below 720, 719. So that may be all we need before this thing turns around and moves higher. So if I were to look at the market and just kind of like assess in the market where we're at, tests of the 50-day are normal. They happen in uptrends. Tests of the 200-day are normal. They happen in uptrends. The market is doing very normal stuff here. So if something abnormal is happening in your portfolio, the only thing that I can say is that means you are out of sync with the market. And in general, I do not recommend ever getting out of sync with the market. So the market is having a very normal, very benign, very gentle consolidation here. That's what we're seeing in our managed portfolios. If that isn't what's happening inside your portfolio, then there's probably something you need to look into. And we know where it's coming from, right? We know it's coming from the chip space. Here's the Kospi. This is the Korean market. And what's interesting is even if you look at the Korean market hasn't entered a downtrend yet. It has only gotten to its 200-day moving average yesterday. So the last time we looked at this thing, I think the Kospi was around 7,200, give or take. It is 5,700 today. So in about 2 weeks or so, it's had about a 30% decline. Yeah, that's par for the course. One of the things that this highlights is, you've maybe heard me say on the channel, the only time that I get really nervous is where indexes get really extended to the upside. And the reason why I get nervous in those moments in time is because there's a lot of air that you have to fall through before you even get signal. In all of this chip wreck, all of the Korean margin calls, all of the drama, all of the back and forth, SK Hynix earnings, all this stuff that's been going on, none of it has generated any signal. There was a little signal around the 50-day. When it gave up on the 50-day, it said, well, we're going to find where we need to bounce, and the next bounce point is probably the 200-day. That's the only signal we have gotten so far. This could all be noise. And if it is all noise, then we bounce on the 200-day and then we go somewhere else after that. I don't think that's what's going to happen here. I think the chip leadership thing is largely done. But that's one of the reasons why I get so nervous when investments pull really far away from their moving averages, because you have to go down a lot. You have to take a lot of pain before you even get any signal. So what does this tell me when I look at the Kospi, when I look at chip markets, Korean markets? No signal has been generated yet. A signal will be generated in the next couple of trading sessions, and we'll know which way it wants to go. Finally, just kind of looking at the market, this is the 1 month trailing on the market. Obviously, I know where the calls are coming from. The calls are coming from Micron down 30%, Intel down 40% in a month, Tesla down 30%, Meta and Google down 6%, right? These have been beloved by retail overloaded on retail, GE Vernova, there's just a lot of stuff here that has been really widely held. But if you look at the heat map and if you look at the market more broadly, this is fine. That benign sideways consolidation that we're having, the reason why we're having that is because Apple's up 15%, Microsoft's up 14%, ExxonMobil's up 13%, MasterCard is up 12%, Verizon's up 10%, right? There's a lot of really great green on this page that was really easy to have access to, right? Like there's no reason why you don't have those things in your portfolio, right? They're very easy to recommend. They're large cap stocks. And in fact, if a bubble is going to pop and if a bubble is going to deflate, this is absolutely the best case scenario for a bubble deflating. Not the money leaving the market, not people getting scorched, even though, if you're overloaded, you're getting scorched, but you kind of deserve that one. But for the money to flow into different sectors of the market is probably the most beautiful deleveraging, the most beautiful bubble pop we can possibly have. If you're a market investor, you have to cheer what is going on here because this is fantastic in a broad market sense. So here's your crash survivors guide. This is not a recommendation. This is not financial advice. This is how I would look at things. And I'm going to give you 3 charts here just to kind of show you how things go. First up, we're going to look at NVIDIA. So if you're in the middle of a drawdown, if you're in the middle of a crash, if you're overloaded on chips and you're nervous, first thing is stop panicking. Do not panic. We're going to look at things very objectively. We're going to use moving averages to determine what is going on, and that's going to tell us what we should do from here. Here's NVIDIA. It's 50 and it's 200-day moving averages. And what do you notice? Well, in its uptrend, and it's been in an uptrend for many, many years now, NVIDIA regularly tests its 200-day, maybe pokes a little bit below its 200-day. And this activity tells you nothing about the uptrend. The uptrend is still in place. The uptrend is still happening. So if we look at where NVIDIA is now, it closed below its 50-day moving average, bounced off its 200, hit its head on its 50, and now it's once again threatening the 200. So what do I think here? I think NVIDIA is generating signal right now. In the next couple trading sessions, it's going to tell you which way you want to go. If it bounces off the 200-day moving average, that's a positive signal. The uptrend is still in place. If it breaks below the 200-day moving average, then the uptrend is broken. And generally, that's the sort of stock that we would recommend reducing on because we're trend followers. That's not advice. Your individual situation is going to be more important than anything I tell you here, but that's how you would do a chart read or a trend following read of these stocks. What I can tell you is NVIDIA also likes to poke below a little bit, so you almost have to give it a little bit of leeway. But up until this point, it's been in uptrend over its 200-day moving average. You don't need to be worried about this one. It's going to generate a signal one way or the other. Next one we're going to look at AMD. This is sort of like the classic one. This is actually what a lot of the chip space looks like, where you have this exponential wild rally. Then it's starting to threaten its 50-day, and it just gave up on its 50-day. Well, where do I think it's going from here? It's at least going to fill this gap and go to 360, and it's probably got a test of the 200-day somewhere in its future at some indeterminate time. We don't know where or when. And so this is a great uptrend, great upward movement on AMD. I think it's going to go to around its 200-day moving average, and then it's going to decide what it wants to do. But there's pain between 429 and 309 where it's 200-day moving averages. That is completely fine. Stocks have to go up and down sometimes. If you bought this thing in March and if you made, 300, 400%, your stuff is going to have to go down a little bit sometimes. To my eyes and a trend following view, this has not shifted over to a downtrend yet. And then finally, so NVIDIA is generating signal on its 200-day. AMD has not generated signal yet. It's got pain in its future, probably, and that's okay. You have to take the pain because the uptrend hasn't ended yet, to my eyes, to a trend-following view. And then finally, we've got Oracle. This is, I looked for something in the chip space that was below its 200-day and looked bad, and I couldn't find anything. But let's say you were following my 200-day system. You would have been out of Oracle in January of 2026. You would have, avoided this drawdown. Maybe there would have been a false rally that maybe pulled you back in, but there were a lot of defects in this moment. Bumped its head on its 200-day, and now it just wants to go lower. This is part of the reason why we like to use the 200-day as generating signal, because the 200-day tells us, is the uptrend over? As of January 2026, it said, yeah, it's over in Oracle. And there was maybe a flash that it was going to re-enter an uptrend after its earnings in June. And now it's been confirmed that no, this thing's in a downtrend. So when something is in a downtrend, if you're a trend follower, what do you believe? You believe that the only thing that you know is that the appropriate price is probably lower. And that condition will remain until it bounces above its 200-day. So there you go. That's your crash survivors guide. One is a watch list. That's NVIDIA. One is good, but you're going to have to take pain. That's AMD. The third one is just pain below its 200-day moving average. That's Oracle. So what I would do, if you're overloaded on chip stocks, I would pull up a chart, put the 50 and the 200 on the chart, take a look, don't panic, be objective about things, and determine if signals are being generated in all of this. And my actual recommendation is never get overloaded in stuff in the first place. So what does it all mean? Well, the market's fine. It's very unusual for me to be receiving so much panic with the market only like 3% off its highs. Diversified portfolios have once again shown their value. Concentrated portfolios have once again shown why they aren't advisable. I do not advise a concentrated portfolio in any way. If you are running a concentrated portfolio and find yourself in an emotional moment in a drawdown, trend following techniques may help you. You have to be objective though. This too shall pass. So if you're undergoing pain, it's okay. It ends at some point. And if you ever want to take a look at stocks or stock charts, most of you watching the channel know how to reach me. Okay, guys, take care. I'll see you next week. Okay, friends, that was the video. Hope you liked it. If you found it informative, good, entertaining, I'd love if you could scroll down here beneath the video and give me a like there. It helps us out with the algorithm. And then if you want to be notified first of anything new that we upload to the channel, if you come over here, click subscribe, you'll be the first to know as soon as we upload anything. Appreciate it. See you soon.